Hi, and welcome to How Was I Supposed to Know That? This is a podcast about the joys and pains of running and scaling a small business and the lessons learned along the way. We've been talking recently about mergers and acquisitions and all the steps and all the stuff that's involved in either buying or selling a company. And today we're going to be talking about contracts. And I am thrilled to be joined again today by my partner at company counsel, Jon Thielen. Welcome, John.
Thank you, Bernard. Good to be back.
Really good to have you here. For people that are listening for the first time today, why don't you tell the audience a little bit about yourself and what you do at company counsel?
Sure. Yeah. So I'm a attorney partner at company counsel. Been working with company counsel for coming up on our 10-year anniversary, which is super exciting. And my role as a partner at company counsel is to oversee some of the other attorneys on the team, manage client relationships, develop new business and network. And then specifically within providing legal services, I do a lot as it relates to M&A, mergers and acquisitions, like we'll be talking about today. Do a lot of contract drafting and reviewing and negotiating for our business clients, and work a lot really closely with our fractional general counsel clients as well.
That sounds great. And I can vouch for the fact that he does do all those things. So far, so good. It's been accurate so far.
Yeah, thank you.
So let's dig back a little bit more into the M&A process.
Yep.
Obviously, you're an attorney, and a lot of what you do in the day-to-day is representing clients through the M&A process again. So maybe it makes sense to start with a brief overview of what that process looks like on a high level from start to finish.
Sure. Yeah, so it varies obviously depending on the type of M&A transaction, whether it's buy side or sell side, whether it's an asset sale or a stock sale. There's a lot of different directions that it could take, but at a high level, it's really about a buyer and seller coming together to that have a mutual interest in getting a deal done, right? And then starting to take the steps towards moving that from a conversation where the buyer wants to buy the business to something more definitive, and that's usually memorialized in some sort of letter of intent that kind of gets the parties on the same page in writing, and is a really important first step. And then from the letter of intent is really when the parties start to dig in and do a lot more work as it relates to getting the deal done. So that includes some due diligence, which I know we talked about on the other podcast. There's a lot that goes into that due diligence process. It's getting a more formal agreement in place that really defines the terms that the LOI kind of set out. And again, there's a lot of different complexities that could come into play depending on the nature of the deal. But ultimately, it's usually about a 60-day period or so from kind of when that due diligence starts to when hopefully that deal closes. And there's a lot that can happen in between. But I would say for most transactions, that's kind of what the legal process looks like in a nutshell.
Okay, so let's go back through the process again, and I'd like to focus on the documents that are involved, the contracts.
Sure. Yep.
Right. So let me paint a scenario for you. Let's say that I've been running my company it's a service-based company, and I've been running it for years. Let's say 10 years.
Mm-hmm.
I've got clean books. I know what my company is worth. I've reached a point where I'm ready to sell, and I've got a buyer lined up. And I'm talking to you. So my question for you is, what's the next step in the process? How do we get the ball rolling? And what's the first contract we're going to need to be ready to produce?
Sure. Yeah, that's a good opportunity for us to get involved, and usually it is that letter of intent. So it's in that scenario again, it sounds like as the business owner you've done some good work up front to make sure that the financials are clean, understand what your valuation looks like, and you've been setting yourself up for a sale event. So that's always really where a lot of the work is done, and we love working with clients that come to us and are already ready. And again, in that scenario, it sounds like a buyer's already involved, and there's some sort of agreement on the purchase price. So that would start to be, those are the types of things that get memorialized in that letter of intent that I mentioned. So the letter of intent could usually come from the buyer. It's really, an offer letter of sorts, right? That the buyer saying, hey, seller, we're really interested in your business. We like what you've been doing. Here are the terms that we'd feel comfortable buying the business on. And it would have some of the major terms like the purchase price, how that purchase price is going to be structured. Is it a lump sum, or is it payments over time, or some combination? Are there lease agreements involved that we need to look at? Is there going to be an SBA funding, SBA loan involved that we need to make sure we address? And when is the deal going to close, right? How long is that due diligence period going to be? What sorts of things are going to be expected during due diligence? And ultimately, when do we want to get the deal done? Those are the types of things that would typically go in the letter of intent. And again, that usually will come from buyer and it gets presented to seller. And then depending on whether one or both sides have attorneys involved, there's usually some back and forth negotiation on that letter of intent. So even though a lot of the terms have been agreed to at that point, there's usually going to be, again, some negotiation, some redlining on the letter of intent until both parties are comfortable and will sign that, and then it can kind of move on to the next step in the process.
Okay, so a couple of questions. First, terminology. You mentioned redlining. Can you explain what that means in this context?
Yeah, sure. So redlining is essentially taking the existing document and proposing changes. So often in the changes are done in Microsoft Word, and there's a feature called track changes. So if one of the attorneys is redlining the document, it usually means they're taking the document that the other side had, they're redlining it or proposing changes to the document, and then sending it back to the other side so that the other side can see, here's the document that we originally had, here are the changes that are redlined and proposed by the other side, and then they can go through and kind of accept or reject the changes that they want to accept or reject.
Okay, so redlining refers to marking up the document.
Correct.
Or essentially editing it or revising it to change certain words or terms so that they are more favorable for your side.
Exactly. Yep.
And that's part of the negotiation process.
Exactly. Yep.
So when you are reviewing the LOI on behalf of your client, and again, you're representing the seller in this story, what kinds of things are you looking for that may be negotiable? What are the pitfalls that you're searching for in that LOI?
Sure. So there's kind of a blend of the legal aspects and then more business aspects, right? So the legal aspects are obviously where we can come in and kind of provide our knowledge and expertise to make sure that the legal terms are favorable to our client. So that'll be looking at things like, what are some of the representations and warranties being made in the letter of intent, right? So reps and warranties are typically going to be made as it relates to the assets that are being sold, or what liabilities the business has, or the financial information that's been provided. There's going to be some representations and warranties that the sides are going to have to make in that letter of intent, and that's something that the wording should be really looked at carefully by the attorney, and is typically something that's negotiated. And then you kind of look at maybe more some of the business terms. So the business terms could be, again, the purchase price, right? The structure of how the purchase price is going to be paid out, the closing date. Those are things that an attorney can certainly give advice on and have input on, but ultimately those things are the decision of the buyer or seller to make sure that the business terms align with what their understanding is. So those are the types of things that we're going to look at from both a legal standpoint and also a business standpoint to make sure the client is comfortable.
So it sounds like it's part of legal issue spotting and
Yep.
identifying things on the legal side that can be improved upon. But it sounds like it's also just an overall review of the LOI to point out things and to flag things, even on the business side, that the client should be aware.
Correct. Yep. Yeah, it's both. So it's a really a joint effort, and even more so, you could have other professionals that are involved. So most commonly, there might be CPAs, tax advisors. If there was a formal valuation done, it could be an actual valuation specialist. There could be financial advisors involved. So the idea is that if you're set up well, you've got kind of all those advisors, and they're all working together and making sure that they're staying in their lane and protecting your best interests. And oftentimes, as the attorneys, we can kind of help quarterback that situation and make sure that, again, if there's something that's more of a tax question, we advise the client to check with their CPA and make sure that they understand what the tax allocation is. So other professionals can be involved in that conversation as well.
Okay, so continuing to look at the LOI, You talked about some of the terms and elements that should be in the letter. What about things like an exclusivity period? Is that something that it's common in deals like this? And if so, is the LOI the place to put that, or would it go somewhere else?
It is, yeah, it's a good point. So an exclusivity period is essentially the period where both parties want to be exclusive to the other as it relates to the deal, right? So up until that point, it could be that sellers listening to different offers from different buyers, or the flip side buyer could be looking at purchasing multiple different businesses at the same time. If there's a exclusivity provision in the letter of intent, what that does is it partially shows commitment of the parties that they're serious about the deal. They want to make sure there's a period of time where if I'm the buyer and I've made a really good offer to the seller, that you're not going to field other offers during that time that were under the letter of intent. So that's something that letter of intents they're often non-binding. So what that means is some of the terms aren't really binding on the parties until an actual formal purchase agreement is signed. But there's usually going to be some language in there that certain terms in the LOI are going to be binding as soon as they're signed, and one of those would be the exclusivity period. So that's important. Not every deal has it, but oftentimes if there is an exclusivity period, there could also be a deposit that's paid as well, just to show again that the parties are serious, the buyer's serious. Here's a good faith deposit, and as a result of you accepting this deposit, I want to make sure you're not going to talk to other buyers during this time.
And how do the parties handle confidentiality at this stage of the process? I'm sure you can imagine that somebody that is selling their company is going to be, there's data, there's personal information, there's financial records. There's a lot of things that are important to disclose as part of the sale that you just don't want to put out there for the world to see.
Right.
So handle confidentiality and making sure that the things that are meant to stay private remain private.
Yeah, it can be a challenge. I mean, confidentiality language should certainly be in all the documents, the letter of intent, the formal purchase agreement. So having well drafted language, confidentiality language in those documents is important. But more so than that, it's making sure that to the extent that you can control who's actually seeing that information that's being disclosed, that's really just as important, because again, at the end of the day, it's great to have strong confidentiality language in the agreement, but you want to make sure that when that information is being shared, it's only being shared with who it should be shared with. So there's usually going to be some exceptions, right? It's expected that parties are going to share financial information with their attorneys or their accountants to make sure they're understanding, again, kind of what the impacts are from a legal and tax standpoint. But you want to make sure that language is really strong, and then to the extent you can keep the parties involved on email correspondence and things of that nature, where you're limiting the parties who are actually on those emails. That's really important as well. It's also important to have some sort of central repository of those documents, and again, to make sure that that's confidential and that only certain people can access that. So oftentimes we'll see secure portals that are set up for due diligence, and that's where the sensitive financial information is going to live, and only certain people can access that.
So a moment ago, you mentioned purchase agreements. Now, purchase agreements are a distinct document or type of document from the LOI. Can you explain a little bit about what the difference is, and really what the difference is between a purchase agreement and the LOI that you already?
Yeah. So, I mean, the big difference is the purchase agreement finalizes the terms that have kind of been outlined in the LOI. So think of the LOI more as the proposal. Here are what the parties generally agree on, and here's what we want the deal to look like. But again, not all the terms are non-binding, or not all the terms are binding rather, until the formal purchase agreement is signed. So that formal purchase agreement is going to take the kind of the skeleton that's been set out in the LOI, but it's going to flesh it out in a lot more detail. It's going to have really a lot more comprehensive language than the letter of intent is going to have around representations and warranties, and indemnification provisions and contingencies. So those sorts of things are going to be spelled out in a lot more detail in the purchase agreement. And again, whereas the LOI is non-binding in a lot of respects, that purchase agreement, once it's signed, is really the binding governing document for the deal. And certainly there can be amendments and addendums and things of that nature that are agreed to later, but that purchase agreement is really the binding document for the parties for the entire deal.
So that's when you really mean it. When you really mean, you say purchase agreement.
Yep. So that's what it really is. Yep.
So if someone were to do a Google search, they would likely find terms stock purchase agreement, asset purchase agreement. Can you explain what the difference is between the two, and when you would use one versus the other?
Sure. So they're at a high level, those are the two kind of main types of deals. An asset purchase or an asset purchase agreement would be when the buyer is really buying specific assets of the seller's business. So oftentimes in that scenario, the buyer will set up a new legal entity, their own LLC that they just set up, for example. And really what they're buying are certain assets from the seller's business. So that could be it could be goodwill, the customer list. It could be actual asset, hard assets like equipment. But it's the buyer taking this kind of brand new legal entity, typically buying assets from the seller's business for a defined purchase price. On the flip side, you hear like an equity purchase or a stock purchase that's really when it's a change in ownership of the actual legal entity. So rather than the buyer, again, setting up a new legal entity and buying those assets, the buyer is becoming the legal owner. Could be a member if it's an LLC, or a shareholder if it's a corporation. They're actually taking over the seller's legal entity and everything that comes with it typically. So there's pros and cons to both. But that's kind of the high level difference between an asset purchase and an equity purchase.
And why might a seller prefer one over the other?
A seller might prefer one over the other because a lot of it depends on the liabilities, right? So if there are liabilities associated with the business and it's structured as a stock sale, then unless they're excluded and specifically excluded in the sale agreement, the buyer is going to be taking over those liabilities. So it could be that there's a loan that the business has, or it could be that there's a line of credit, right? That's open for the business. The seller typically in a stock sale is because they're selling the legal entity. They're selling the assets and liabilities that are associated with that. So a seller could prefer a stock sale if the buyer is going to be the one assuming those liabilities. And obviously those are things that have to be disclosed, and the purchase price would be adjusted accordingly. So, but it could be advantageous for the buyer as well in some scenarios to actually take on those liabilities and set it up as a stock sale.
So whether it's an asset sale or stock/equity sale, are the mechanics of the process the same, or how do the mechanics differ, if not?
Somewhat. The main steps that I outlined as it relates to the letter of intent, the formal purchase agreement, due diligence, a closing date, those are pretty much going to be the same for both transactions. But the specifics of the agreement, the type of agreement is going to be a little bit different. So again, an asset purchase agreement is going to be different than an equity purchase agreement. So those are some things that are mechanically different. There's also going to be.
Could I just cut and paste, right? Like find and replace anywhere where it says stock, replace that with asset and call it a day?
You could try, yeah. You could try and see how it goes. So there's definitely more to it than that. I mean, part of it is, again, because there's an actual change in ownership of the business in a stock sale scenario. There's also amendments that need to be filed with the state and with the IRS and with the bank. So it's not, again, from a buyer standpoint, oftentimes it's cleaner to do that asset purchase because you're setting up this brand new legal entity. It's clean. You're just taking over some of the seller's assets. But in that, again, in that equity example, a lot more typically needs to be done on the back end to make sure that amendments are filed. You're removing the seller from the bank account. You're changing the name associated with the EIN or the owner on the state. So those are things that you might not think about if you're just cutting and pasting and doing a ChatGPT changes to the contract. So
I see. So let's get back to the purchase agreement. I'm wondering if you could outline for the listeners what some of the major components are of the purchase agreement. What are some of the things that we should be looking for as we are as business people reviewing the contract?
Yeah, so some of what we talked about already, representations and warranties are going to be important. And again, that's really disclosure on what assets are being sold, what liabilities and debts are being sold and disclosed. So that's really important. The purchase price allocation is something. So we talked about the actual purchase price itself. Purchase price allocation refers to how the purchase price is allocated for tax purposes. So that's something that, again, we'd recommend looping in your CPA on. But that's something that people often overlook, is especially if it's an asset sale and there's different types of assets being purchased. Again, there might be goodwill, there might be certain equipment. If you can, those can have different the purchase price can be allocated in different amounts towards those different assets, and that can have different tax implications. So that's a really important term and concept to look at with your CPA in the purchase agreement. Outside of that, there's, again, some of the post-closing amendments to look at. I think those are often overlooked, making sure that when the deal is done, the deal's not always done at closing, right? That certain amendments might need to be filed to protect the parties post-closing. And another big one is indemnification. So I know that's a term not everyone's familiar with. Indemnification is basically if something happens and there's some sort of claim or lawsuit or damages, typically after the deal is done, who's going to be responsible for covering the costs associated with that. So we've seen some examples before where a company will buy assets, and maybe it's a coffee company, right? The coffee company buys this existing coffee business that's got a coffee roaster that is their main piece of equipment and drives all the operations, and then and they pay a lot of money for that in addition to everything else with the business. And then the day after closing, that coffee roaster breaks, right? So who's responsible for paying for the repairs or buying a new coffee roaster? That's where like indemnification provisions are going to be really important, of who bears that risk of loss, who pays for these things post-closing. Was it something that the seller maybe knew about and didn't disclose, or was it just bad luck? So that's something that, again, is not always paid enough detail to.
Now, what about disclosure schedules? Can you define the term and talk about how disclosure schedules fit into the purchase agreement, or how they work along with the purchase agreement, I should say?
Sure. So disclosure schedules they're basically exhibits, oftentimes exhibits to the agreement itself. So kind of the sale agreement is, again, all the legal terms that we talked about for the deal. Disclosure schedules tie into due diligence, and what they do is they spell out certain things that are being disclosed in the agreement itself. So if the seller has contracts with their suppliers, right, that would be something that comes out during due diligence, but you would also want reference in the agreement. And there might be a reference to a disclosure schedule that says disclosure schedule 2B contains all the vendor agreements that the seller has. And then at the end of the document, there would be that disclosure schedule as an exhibit, and it would list those out specifically. So that's a really good way to make sure, again, that really everything in due diligence is being disclosed, and then the buyer can't come back later and say they weren't aware of something, because the disclosure schedules should ideally disclose those sorts of things.
Okay, so schedule, the word schedule in this context means list, and these
a list or an exhibit. Yeah.
Okay. What about things like assignments and assumption agreements? Can you talk about that?
Sure. Assignments and assumption agreements are oftentimes for material contracts, making sure that those contracts are being assigned and assumed by the buyer. So that's a really important thing that we probably talked about during the due diligence conversation of making sure that material contracts for the seller, if they're being sold and transferred to the buyer, are able to be assigned over and assumed by the buyer. So
John,
oftentimes there might need to be a separate assignment and assumption agreement that where both parties to that contract are agreeing that that this deal is happening and that the seller's assigning their contracts to the buyer, and that the other party to that contract agrees to it. So we see that oftentimes with lease agreements. So making sure that, again, if you're a buyer and you're taking over a business that has a 10-year lease agreement and you're only 3 years into that lease, you want to make sure that that lease is going to be able to be assigned from the seller to the buyer. And oftentimes you'll need to pretty much always need to get the landlord's consent to do that. So there might be a separate assignment and assumption agreement where the landlord is saying, I'm agreeing that the seller is assigning the lease to the buyer, and that buyer will become the tenant of the property.
Perfect. So now I understand what assignment means, but I don't know what a material contract is. So can you explain that for the audience, please?
Sure. A material contract is a contract that's material. So it can be defined in the agreement. It's not always written that way, that it's a material contract, but the gist of the idea behind a material contract is again a contract that's important to that's important to the business. So not all contracts, again, in an asset sale might necessarily be transferred over to the buyer, but client agreements and lease agreements and things of that nature are going to be typically the material contracts that are listed out and that are often defined and referred to in the agreement.
So a material contract means an important contract, a key contract.
Yeah, that's a good way to define it. Yep.
And it doesn't have anything to do with products or materials or anything of that nature.
Not necessarily. It could. I mean, a material contract could be a contract related to materials, but yeah, more often than not, material contract means important contract.
Okay. Yeah, I want to understand everybody. I want to make sure that everybody understands.
Yeah.
Because material means different things in different contexts. So when an attorney talks about a material contract, they're not referring to necessarily anything physical or tangible. That's the subject. Right. It's material just means key or important in this context.
Correct. Yep.
So another couple of documents that you might see come into play in the M&A process, the promissory note and the employment agreement. Can you talk a little bit about why those documents would be involved in the sale of a company and what the elements of those documents would be?
Sure. Yeah. So a promissory note is similar to a loan agreement. So usually that comes into play if the seller is financing part of the deal. So it could be that the purchase price again is not being paid from the buyer to seller all as a lump sum at closing. It could be that the seller's agreeing to accept that payment over time. So in that situation, you would want a promissory note to make sure that the payment terms over time are memorialized and that the buyer is going to make those payments over time to the seller. So a promissory note would come up in those situations, and that's not uncommon. And then oftentimes relatedly is an employment agreement for the seller. So again, a lot of times there's what's called like a post closing transition period where the buyer wants the seller to stay on as an employee for the business for a period of time. And that helps with the transition. It helps to make sure that it's a smooth process, and the employee or the seller rather can lend their expertise as an employee for a period of time post closing. So that would be a situation where you want to make sure that there's an employment agreement that's referenced in the main agreement and that's attached as an exhibit, and that would basically define what the seller's terms of employment are going to be post-closing. So how are they going to be compensated? How many hours a week are they working? what are their roles and responsibilities? What happens if you want to terminate? Is that possible? So those are two documents that we definitely see come up.
So we've talked about a lot of documents today at pretty good depth. The LOI, the purchase agreement, whether it's a stock purchase agreement or an asset purchase agreement,
Yep.
Disclosure schedule, assignment. Other than hiring a great attorney such as yourself, what are some things that a business owner should keep in mind as they go throughout this process and they start getting inundated with paperwork? What suggestions do you have for them to get through it all?
Yeah, definitely trying to, again, ask for help when help is needed, right? Make sure you're talking to your advisors in your network. And if you don't have advisors in your network, then talk to one that you do have, or get referrals from people that like and trust. And again, what that can do is it helps everyone stay in their lane and give guidance where they can give guidance best, so that you don't have to feel like you're doing everything as the seller. So we see deals go really successfully when attorneys are involved and tax advisors are involved and financial advisors are involved. So again, everyone can do their part and represent their client and their client's best interest. But again, the seller or the buyer doesn't have to do it all themselves. So I think keeping that team or finding that team, just starting to have conversations and try to find those advisors is really important. And then a lot of kind of what we've talked about to make sure that the business is in good health on an ongoing basis. And that can be, again, working with a law firm like us to make sure that you're not just scrambling at the last minute when you're ready to sell to get your ducks in a row. You're doing things on an ongoing basis to keep the financials clean and keep your governance documents clean and do those sorts of things. And again, that's gonna really tee you up better for a successful sale.
And if someone did want to hire you or pick your brain or reach out for a consultation, what would be the best way to do that?
Yeah, that'd be great. So I think our information will be provided on the podcast. We're Company Counsel LLC. So www.companycounsel.law. You can actually set up a consultation right there with me or one of our other attorneys on the website page directly, or you can call us and set up a consultation that way. And we do free consultations all the time. So we're happy to, jump on for a half hour if you're a business owner, you're looking to buy a business, and again, just kind of talk through the specifics in more detail and see what we can do to help. And, hopefully it turns into something, but if it's just, kind of answering some questions, we're always happy to do that as well. So there's a few different ways to get in touch with us. And again, we're always happy to have those conversations.
Well, I want to thank you, John, for being on the podcast today to share your experience and your wisdom. It's been great. I know you've helped somebody today. Thank you again for being here.
Thank you for having me. It was great.
He's Jon Thielen. My name is Bernard Williams, the Company Counsel, and this has been another episode of How Was I Supposed to Know That? Thanks, everyone.